important to get a pre-approval. In general, the goal of a pre-approval is to make sure that you are confident you can be pre-approved, but you're also comfortable with the numbers, so you're ready to make an offer and you want to buy a house. When you add it all up, here at CFCU, we have over 20 different loan options. With a pre-approval, we will look at your complete financial picture to determine the best loan option or options for you and your family. The nice thing about a generic pre-approval is that we can look at all of the loan options we have from one application. There's no need to feel that you have to fill out multiple applications for the different loan options. Now, with a pre-approval, we look at three main things. We're going to look at your credit scores, your debt to income ratio, and then the available assets you have for closing. With your credit, we will pull a tri-merger report from all three of the credit bureaus for anyone who's listed on the application. So please make sure anyone applying that you've unfrozen your credit if it has a freeze on it. When looking at your credit, we will look at the different debts that show up and what your credit scores are. With the debts, we're going to look at your debt to income ratio. This is where we calculate out the debts on your credit report plus the proposed monthly mortgage payment, divide that by your gross monthly income, whether it's one person or two people, or three people. And then from there, we'll see what your ratio is. This ratio is the magic number on paper that says what price range you can be approved for. Now, please know, this number is an important number, but it's not the most important number on an application. We are going to make sure that you're comfortable with the payment, so that way it's something that you want to afford every month instead of just maxing out the payment. We understand that real life budget and paper budget are very different things, and we'll work with you to make sure that you're comfortable with all the numbers. For the assets, we're going to look at funds that you have available, whether it's in a checking or savings account, a stock or bond account, your retirement funds, or maybe you have gift funds from an immediate family member we can use. After reviewing your complete financial picture, we'll be able to say, based on the information that you gave us, what type of loan programs you can look into. And as I mentioned, we have quite a few, and a couple people are going to talk about them later on. Please know that with a pre-approval, it's a working document. After we've started you with a pre-approval and you have some numbers in a price range, you might find a house in a different price range, and that's perfectly fine. We can easily update it and look into different scenarios, maybe different loan options as we need to. But the goal, again, is to just make sure you're comfortable with all the numbers before you make an offer on a house. Now that we've gone over those basics, up next is going to be Sean, who's going to be talking about a little bit more information about what's needed document-wise for the pre-approval. Thank you.
All right, thank you, Nicole. Good afternoon, folks. Again, my name is Sean, work at the main office, 1050 Craft Road. And so, yeah, I'm going to be talking about what documents we need from you to pre-qualify. So I'm going to go over all the documentation that you'll need to get us so that we can pre-approve you. It's basically a second step, the first step being the initial online application. And then this would be the second step where you get us the documentation that we need to basically complete the pre-approval. And there's a few ways you can get us the documentation. So one way, you could either email everything directly to us as PDF attachments. Another way, you can actually upload the documents into our application portal, or you can just do it the old school way and just physically bring everything into us. So whatever works best for you. So yeah, we'll get started. These are in no particular order, but number one, pay stubs. So if you're employed, we need proof of your income in a couple different ways, but one way is by way of pay stub. And that needs to cover the most recent 30-day period. So if you get paid every week, then we would need 4 pay stubs, your last 4. If you get paid bi-weekly, then we would need 2 pay stubs. Okay, number 2, W-2s that come from your employer, covering the most recent 2-year period. Okay, number 3 is going to be tax returns. So we need tax returns complete with all schedules for the most recent 2 years if you are self-employed, have rental income, or have commission income. Also, if you own your own business, you are required to provide the most recent 2 years of business returns as well. All right, number 4, 1099s and award letters for the most recent 2-year period as well. And those are needed if you're collecting Social Security, pension, or retirement. All right, number 5, bank statements. So we need statements covering the most recent 2-month period, or a full 60 days. And this is to verify your funds to close, just your assets in general to make sure, you're not using every last cent of, money you have to go towards down payment and cash to close. We also need to make sure that there hasn't been any unusually large deposits into the account. And if there are, processing may need some additional documentation to go along with that. Okay, number 6, real estate owned. So if you own any real estate that you are not selling, like if you're buying a second home or even just doing an outside refinance to your current home, you will need to provide us with the most recent mortgage statement, property tax receipts, and a proof of homeowner's insurance. If you happen to be selling property, we would end up needing a copy of the purchase offer as well. All right, number 7, separation agreement and divorce decree. And this is to provide proof of property buyouts, child support, and alimony. And lastly, number 8, we do need valid identification. So a non-expired photo ID, such as a driver's license or passport. Also for non-citizens, we would then just need like your visa paperwork or green card. So yeah, so that's everything. Let me just do a quick recap for those who might be taking notes. So number 1, pay stubs. Number 2, W-2s. Number 3, tax returns. Number 4, 1099s and award letters. Number 5, bank statements. Number 6, real estate owned. Number 7, separation agreement and divorce decree. And number 8, valid ID. Now you'll be hearing from Jayne Ellis, who will be going over down payment, prepaids, and closing costs. Take it away, Jayne. Thank you, everyone.
Thank you, Sean. Hi, everyone. My name is Jayne Ellis, and I work at the Trip Hammer branch of CFCU, and I'll be going over down payment, closing costs, and prepaids. And those 3 items are what a borrower is expected to bring to closing in funds to close their mortgage. So, what is a down payment? A down payment is the initial payment made toward a real estate purchase, and it's the difference between the purchase price and the loan amount of your mortgage. Different loan types have different minimum down payment requirements, which are represented as a percentage of the home's purchase price. A down payment of at least 20% of the purchase price, for example, can eliminate the need for mortgage insurance and lower your monthly payment. What are closing costs? Mortgage closing costs are the fees that you pay when you secure a mortgage loan, either when purchasing a property or refinancing an existing mortgage. You should expect to pay between 2 and 5% of the property's purchase price in closing costs. Some examples of closing costs include appraisal fee, New York State mortgage tax, buyer's attorney fee, title review fee, and recording fee. Closing costs vary between financial institutions, and you will likely pay fewer closing costs if you choose to work with a credit union. It is important when inquiring for mortgage products to be aware of your closing costs and what they pay for. Credit unions tend to omit arbitrary closing costs such as application fees, processing, and underwriting fees. At CFCU, we're proud to share that just last year alone, we saved our members a total of $1.5 million in closing costs with our no closing cost options. So that brings us to prepaids. What are prepaids? The term prepaids includes the sum we must collect for the home's property taxes and homeowner's insurance to fund the escrow account and per diem interest due at closing. When purchasing or refinancing a home, there will be closing costs and prepaids due at closing. They are two separate things. A home buyer will benefit from a no closing cost mortgage option with CFCU, as this will lower their total cost to close significantly. However, borrowers will be responsible for their own attorney's fee, even when taking advantage of a no closing cost option. So in conclusion, a borrower's total cost to close consists of down payment, closing costs, and prepaids. The total sum of the three is what you can expect to bring to closing as the home buyer to purchase your new home. Thank you all so much. And now I'll introduce you to Missy Park, and she will be going over conventional loans and government loans.
Thank you, Jayne. So my name is Missy Park, and again, I'm at the downtown Ithaca Commons Transformation Center branch, and I've been doing mortgages for about 13 years, and prior to that, I actually sold real estate for 6 years. So conventional mortgages and government mortgages. I'll start with giving a little rundown on conventional loans. So a conventional mortgage is not insured by a government entity like the government loans are. They're, I would say, by far one of the most popular mortgage loans. Conventional loans, we offer those in fixed rate, ARMs, or what's called adjustable rate mortgage, and jumbo loans. So our fixed rate mortgage loans, conventional, offer the nice version of having the same exact principal and interest payment throughout the term of your mortgage loan. So you're doing a fixed rate conventional 30-year, you're going to have the same principal and interest payment for that 30-year term and the same rate as when you lock in that interest rate. That'll be your rate for the term. Adjustable rate mortgages are a little different in that interest rate is going to change based on that adjustable rates term. So, for example, we have a 15-1 adjustable rate mortgage option, and it'll be fixed at the initial rate that you lock at for the first 15 years of that loan. But then on year 16, that loan's going to be subject to a rate adjustment, which means your principal and your interest payment is going to change. So it's a little bit riskier for the borrower, but they typically have a lower interest rate because of that risk. So it's a great option, especially if you're not planning to be in your home for a long time, if you're going to be in your home for 10 years, 12 years, that type of thing. Adjustable rate mortgages can be very confusing to people, and they do need a lot more explanation. So I highly suggest reaching out to any one of us, and we can go a little more in depth with it for you at that time. Let's now talk about our government loans. So government loans are insured by the government providing the loan. So this means that the government entity agrees to repay a percentage of that loan back to the lender if you, the borrower, were to ever default on that loan. So we as a lender are protected. Our first government loan is called FHA. Probably many of you have heard of this mortgage. This loan is insured by the Federal Housing Administration. FHA loans are not just for first-time home buyers, so you can be a repeat buyer, but you cannot have more than one FHA loan at one time. They're very popular for first-time home buyers, though, because of their low down payment requirement. So you can do an FHA loan with as little as 3.5% down payment and with credit scores of 620 or better. FHA mortgage loans do require a monthly mortgage insurance premium that is life of the loan, so it will never drop off. Whereas on the conventional loans that I spoke of earlier, if you do less than 20% down, as Jayne had mentioned, you're going to also have that monthly private mortgage insurance. But on the conventional side, it will actually drop off once you reach 78% loan amount to the appraised value of your home. So the FHA loans, it is life of the loan. And we just got news today that the monthly mortgage insurance for FHA, that cost has decreased. So that's going to be a huge advantage for any FHA mortgage borrowers out there. So that's great. FHA loans also have a one-time upfront fee. It's 1.75% of the loan amount. We can figure that out for you at the time. That one-time upfront fee can actually be rolled into your loan. So you don't need to, sorry about that, my laptop tipped. Live people, we're live. So that one-time fee is not extra cash that you need to bring to closing. We can roll it right in. Our next government loan that we offer is called USDA. This loan is insured by the Department of Agriculture, and this loan is meant to enhance rural development. So you're not going to be able to do a USDA loan in the city limits of Ithaca, city limits of Cortland, city of Auburn, you know, that type of thing, city of Syracuse. You can do villages, that's fine, but just no city. So USDA mortgages are also not just for first-time homebuyers, but very appealing because they are zero down payment. Truly a zero down payment mortgage loan. And credit scores for this loan, 640 or better. Couple things about the USDA loan. You must income qualify. On it. Sorry, my laptop is not cooperating. So you must income qualify for the USDA loan, and income limits are actually based on household size and county where you are purchasing. And that income is actually household income. So if you yourself are going on the mortgage, but you have a partner living with you and they work, they have income coming in, that partner's income must be looked at to be sure that you income qualify for the mortgage loan. USDA also has a one-time upfront fee, also able to be rolled into the loan, and that life of the loan monthly mortgage insurance. So one thing that FHA and USDA both allow is for what's called a 6% seller concession. And this means that you can bump up your purchase price by an additional 6%. The seller will then credit that 6% back to you at closing, and you can use that towards your closing costs and prepaids that Jayne had talked about earlier. So this will make your cash out of pocket, that cash to close, much less for you. So it's a great way to do it. So for example, let's say that the seller wants $100,000, just an easy number to work with. We would make the purchase price $106,000, and the seller would still get or net walk away with $100,000. They would credit that $6,000 back to you at closing, and you'll use that to chip away at those closing costs and prepaids. So great way to close on a home with needing a little less money out of pocket. Our last government loan is VA. So VA loans are backed by the U.S. Department of Veterans Affairs. VA loans require at least a 620 credit score, and they are also 0 down payment. So we have 2 loans that are 0 down payment. The great thing and the great benefit of VA mortgages is there is no monthly mortgage insurance premiums at all. So no worry about that extra fee in your mortgage payment for that. That's a huge advantage. VA loans do have an upfront funding fee, but if you, the veteran, are considered 10% or more disabled, that entire funding fee can be waived. VA loans allow for a 4% seller concession. So just like what I explained with the 6% concession on FHA and USDA, you can bump up your purchase price by that 4%. You'll get that credited back to you to help chip away at those costs to close. So another great way to do it. So to qualify for a VA loan, you have to be an active duty service member or an honorably discharged veteran. You must have served more than 6 years in the National Guard or Selected Reserve, or be the spouse of a service member who has passed away in the line of duty. And to apply for a VA loan, we're going to need your certificate of eligibility and your DD 214. CFCU wants to thank all of our veterans for their service. Thank you very much. We appreciate it. Now I'm going to turn things over to Kim Rozell. Kim's going to walk you through the process from what happens once you pre-qualify on through closing on your new home and getting the keys and moving in. Kim, now that I flipped my laptop for the 3rd time.
Thank you, Missy. I'm Kim Rozell, again from the East Hill CFCU branch. I'm going to just talk about kind of putting it all together and what happens from the time you're pre-approved. So once you've connected with your mortgage originator, you've reviewed your pre-approval, you know what types of loans you're eligible for, you're going to then want to start shopping for a house. And just to put this out there, it is so tempting to look at Zillow and all the houses that are on the market. You definitely don't want to start looking at houses, going to viewings until you've worked through the pre-approval. For 2 reasons. You might be looking at houses that are outside of your price range. So it's just good to have that information and knowledge with a pre-approval and then start shopping for a home. Plus, with a very competitive market here, you're going to want to have that pre-approval all set and done so that when you do find that house, you can go ahead and make an offer really quickly because, as I said, it's a hot market. And so you have to be able to act quickly. And if you find the house first, you then got to backstep and then get pre-approved. So you definitely want to get that pre-approval done by connecting with your originator, getting all those documents Sean mentioned, working through the pre-approval. And once you know if you're doing a conventional loan or maybe you're doing a government loan, you would reiterate that information to your realtor. So in most cases, people will find a realtor to help them walk through the process of finding houses, putting in offers. You don't necessarily need a realtor. Maybe you have a friend selling a house, so you could do a for sale by owner. But in a typical scenario, I would find that there are realtors who are out there helping the buyers. Again, look at houses and make an offer. So once you've got that accepted offer, maybe it's the first house you find and make a bid on, or maybe it's the 3rd or 4th. But once you have that accepted offer, you're going to go through a few more motions. You're going to go through an attorney approval period, and that's where an attorney is going to review the contract to make sure that your best interest is looked at and taken care of. And then you may do a home inspection. And once these things have passed, the attorney review and the home inspection, you're going to then actually apply for the mortgage. And at that time, you're going to define which loan product you want to finance with and exactly what terms. Maybe you originally were going to do 5% down, but a little bit of time has lapsed. Now you can do 10%. That's completely fine. We would determine, here's your contract, here's the numbers, and here's your application. And then you decide on that, you sign all the paperwork. And then from there, the application, there's going to be some behind the scenes things taking place. So here at CFCU, we have a great team from your mortgage originator to our processing and underwriting team. They're here at CFCU. So we would be getting the application sent over to processing. We're going to get an appraisal ordered. You're not going to be involved with that, so you can kind of just sit back and relax while we do a few things, such as the appraisal, a flood certification. We will ask for some updated documents. So at the time you pre-approved, you brought in pay stubs, W-2s, bank statements. But if it's been a little bit of time, we will probably ask for most recent updated pay stubs and most recent bank statements. So during that application processing phase, we're going to do the appraisal, we're going to update documents. And while all that's taking place, the attorney should be working on an abstract update, a tax search, some title packages that need to make their way to CFCU. And again, if you have a realtor that's working with you, they should also be staying in contact with the attorneys to make sure that this work is being done. Because it's very important that everything happens in a timely manner so that we can make a way to closing, so you can be a new homeowner. So you've applied, we've got the appraisal back, you've given us all the documents we need. We then issue a commitment letter. That's a financing commitment letter that says everything's good to go. We're all set, you're approved for the loan, we're just waiting for that title package. And then from there, once the title package is in, CFCU's legal team, which is also here locally, will review the title package and then make our way to closing. The typical time frame, it used to be pre-COVID, it could be anywhere from 40 days to 60 days. We're still running around that 60-day mark. It can be, again, a little bit more or a little bit less. It's just dependent on how quickly things are being done, such as title package and how quickly you return documents to us that we may need. So it's really important to get a team working for you that's going to help move you through this phase. So again, your mortgage originator is going to help you know what you're pre-approved for, what loan products fit your needs, so you can make an educated decision. And then you're going to have a possible realtor and an attorney walking you through this to get you to closing so that you can be a new homeowner. So those are the basics of getting pre-approved, what we will need to be collecting in order to pre-approve you, and we look forward to assisting you. So I thank everybody for speaking, and I'm going to turn it over to Luke for our Q&A.